Welcome to September 21st, the day after Fed decision and Fed comments. And now we get to unpack what Chairman Powell said, the dot plot, and a whole lot of other stuff. So let's dig into it here. The Fed definitely is living with rose-colored glasses, and they are not acknowledging the real-time numbers with inflation and jobs numbers and what jobs actually make up those jobs numbers. So let's get into some details here. Overall, the Fed left the Fed funds rate unchanged, but they did signal the likelihood for one more increase over the next two meetings, which we're actually running about a 70% chance of no raise in the next two meetings. So it was one shot across the bow. They also priced in two price cuts for 2024. The market was actually factoring in four rate cuts. So second shot across the bow within the commentary. They continued the statement of a dual mandate, maximizing employment while controlling cost increases for inflation. That was the primary statement and repetition, and that they were, of course, stating they were data dependent. They have upgraded the economic conditions over the next year. They increased GDP estimates. Let's go into the details here. So, like I said, they kept the Fed funds rate unchanged from between 5.25% and 5.5%. Economic activity has been expanding at a solid pace versus moderate statement in the previous report. So they're doubling down on what they perceive as strong employment. Keep in mind, they have yet to factor in or talk about the lower work hours per week and the growth of jobs is specifically in the part-time employment. So they left that out of there conveniently. Job growth, they did acknowledge, slowed, but still remains strong and robust. So that's a commentary for jobs. Fed forecast GDP, gross domestic product, increased for 2023 from 1% to 2.1, doubling of expected GDP. Unemployment rate, they decreased the expectations for 2023 from 4.1% to 3.8%. PCE inflation, they increased for 2023, the estimates of 3.2 to 3.3%. So they're seeing a slight increase in PCE inflation. PCE core, they are expecting a decrease from 3.9 to 3.7. So there's definitely differences between the headline and the core in producer or wholesale inflation and consumer inflation that they're acknowledging. Fed funds rate, the median forecast is 5.6%, same as June, and that does imply one more hike in the next two meetings. 2024 forecast, median forecast of 5.1%. Fed funds rate now decreased to versus a 4.6 is what they were stating before. So they're showing a higher forecasted for 2024. They're saying instead of four rate cuts, we're likely showing two rate cuts. That definitely hurt the bond market significantly. And they stressed higher for longer as their tagline. In the press conference specifically, talked about what the last labor report was what we wanted to see because that showed some decrease and revisions. Wage growth did show some signs of easing, but they didn't get into like I said before, the fewer hours worked and the part-time. Now, specifically, we know the Fed is not very good at looking down the road and anticipating what will be happening in the economy, as evidenced by Chairman Powell's specific quote in response to how will the Fed know if they are hiking too much or are too restrictive. His reply was, he will know overly restrictive only when you see it. They're looking through rose-colored glasses and believe we're going to see a much stronger economy next year. It's in sharp contrast, though, to the leading economic indicators, LEI, that came out today, which showed continued contraction of 0.4% for the 17th consecutive month. So when they're talking about we will know it when we see it with recession and lower numbers, by that time it is too late. That's the problem. If you've got a train and going 60 miles an hour, you can't just turn on the brakes. You have to ease into it. With the change to the 2 rate cuts from 4, it's showing the market that the Fed really doesn't know what data will show them when to slow down or when they reach their ultimate goal. Today we saw, being Thursday, initial jobless claims. Man, a 4th hit to the bond market with jobless claims. Came in, the initial claims came in up 21,000 or 20,000 compared to expected. Continuing claims decreased 21,000 to 1.66 million. Both those were not what the market was forecasting, and took a negative hit to the market. Existing home sales. This was a big number that we were looking for when we started to analyze this morning. What would it show? Existing home sales showed, what that does is shows closings on existing homes. Decreased by 0.7% in August to 4.04 million annualized, which was weaker than existing estimates that we were planning on. The pace of sales are being kept down by, you guessed it, inventory, which is roughly at levels of half of what they were in 2019 when that was even tight. So the inventory levels continued to decrease by 1%. To 1.1 million, down 14% from last year. There are 3.3 million homes for sale right now. But if you look at active listings, there are only 582,000 because a lot of those existing sales or listings have contracts on them. The media doesn't talk about that, unfortunately. What the net sales are net inventory is available for buyers. Homes remained on the market for 20 days. That number remained unchanged, still showing a very strong demand. 72% of homes sold in less than 30 days, and that's down 74%. If homes are priced correctly, they're selling fast, as we all know in our West Michigan market, because it's hard to get deals accepted. First-time buyers accounted for 30% of the market. Cash buyers accounted for 27% of the market, which was up just a little bit from 26%. Investors made up 16% of the transactions. That's a breakdown of what's out there. National Association of Realtors, NAR, did a survey asking prospective home buyers what their first or second reason is for not buying a home today. Number one, we all guessed it, was they wanted to wait for rates to come down. What we're telling everybody is when rates come down, competition spikes, and then homes go up slightly more than what they are now. So timing the market for the lowest interest rate doesn't mean you're going to get the best deal on a house. Keep in mind, it sounds odd, but the best time to buy a house is actually when the rates are the highest. The second biggest reason for not buying a house right now is due to multiple offers, which we're seeing crazy still. Technical analysis, what's going on in the market today? Mortgage-backed securities down 45 basis points. 10-year was up 10 and has spiked at 4.47. There is some overhead resistance at 4.48 that we're hoping we bounce down from. So overall, it's a red day in the market. Not what we were hoping for from the Fed comments, but we are here helping our buyers get pre-approved. Give us a call, 616-293-2189.